Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinnii Motiwala, and thank you so much for tuning in as always. Now, today, what we're going to be putting the spotlight on is the factors behind a winning portfolio, generating high returns in a especially dynamic market like India. We know that behind every successful portfolio creation is a CIO who not only tides the different market cycle waves, but also makes sure churning is important at different stages of investment. This and more is what we're going to be discussing with one of the marquee CIOs, that is Ashish Gupta of Axis Mutual Fund, joining in with us today to talk to us about their strategy, how they follow in different tide cycles, what do they do with different funds. So, Ashish, thank you so much for joining in with us on this show. And, it's a pleasure having you here. I want to just start by talking about the basic philosophy that you all follow at Axis Mutual Fund in terms of when you're making core investments. What is it that you all have evolved? Especially, there are so many diverse funds. So, for each fund, how are the strategies that you all follow?
So, Vinnii, our investment philosophy is based on certain core beliefs. Firstly, we believe India is a growth economy. It houses several strong, sustainable businesses that have actually the potential to grow even faster than the nominal GDP. We think the Indian market dynamism offers significant potential for alpha generation through active management. And to identify such companies, identify these businesses, we have a very strong focus on research. The research focus is on identifying companies that have a proven track record, are demonstrating profitable growth, and where we are seeing an acceleration both in cash flows and shareholder value generation. And basis this identification, we follow a bottom-up multi-cap stock selection approach. Our strategies are more tilted towards buy and hold because we believe that generates sustainable alpha over time. And we are very clear that for most of the portfolios that we manage, we look across market cap cohorts because over the years we have seen good and growth businesses are not confined to any particular market cap. In fact, even market leaders in some sectors are represented in the mid cap and the small cap sector, right? So, for example, if you are positive on healthcare and hospitals, most of those companies you will find in the mid cap space. So I think you have to be nimble enough to look at opportunities across all market caps. As you mentioned, we run several diverse strategies, and the way we structure each of the portfolio is that each is headed by an individual fund manager. And while the core beliefs are common, the focus of each fund manager is to the strategy of that particular fund.
Absolutely. Ashish, India is such a fast-moving market. You're also betting on India. That's how you started as well, right?
Yeah.
What are the key factors that you keep at the top of the mind? Just if someone is, wanting to construct their own portfolio as well, what
Sure.
are the key factors that one should watch out for right now?
Sure. So you're absolutely right. So the first step is actually the stock selection. But for the portfolio to have the right balance, I think position sizing has to be optimized. And you have to look at multiple factors, including liquidity, volatility, valuations. You have to look at the covariance between the various stocks. And also in our portfolio strategy, and you mentioned that because the market is always changing, sector tilts are also very important, right? So at one point of time, while you may have a positive view on certain companies in a sector, but you may actually reduce the weightage of that sector given on the broader macro environment. So I think in addition to stock selection, you have to get the right balance both in terms of size of the positions as well as really sector tilt, market cap tilt. So if you recall last year when the markets were at a high, valuations had moved up and we actually gravitated more towards large cap stock that were better valued, right? So I think those are some of the things that have to be continuously monitored and rebalanced.
Absolutely. Ashish, there's one thing that how do you, like you're saying as well, right? When valuations go up, how you all focused and how you all changed your strategy as well. Could you elaborate a bit more in terms of balancing this growth versus value stocks? And how do you keep adjusting that? Because there will be pockets where you suddenly find a lot of value, but you want growth as well. So, how do you manage that? And some of these stocks are, no matter what, how expensive they become, they are the best ones to hold. So then how does that strategy play out?
Sure. So, see, one, the markets are cyclical by nature, right? And within a market cycle, you see different styles coming in and out of favor, depending on certain macro factors. For example, COVID was a big trigger for companies that were beaten down, where price to book multiples were low, that was under-owned, or had steady cash flows. And the value stocks performed really well for a couple of years over the time period. Another trigger, for example, is how the interest rate cycle moves. And whenever you see peaking of the interest rate cycle, you see actually growth companies start to get valued better. In fact, when there is a slowdown in global growth, the premium for growth companies actually starts to enlarge. But you have to be equally cautious because if there's a growth slowdown and growth in a highly valued company comes down, then you actually see derating of the stock in addition to the EPS cuts. Over the long term, of course, we believe that empirical evidence is quite conclusive, that growth and quality style of investing work very well particularly in a high growth economy like in India. Having said that, you have to have a focus on valuations, particularly when the macro factors are changing.
Okay, just a follow-up, because you're mentioning macro factors as well. There's so much right now to manage in those global uncertainties and macro factors. How do y'all manage one risk at, portfolio level for y'all, as well as for an individual investor? What would be that advice that you would give in when they are looking at their portfolios?
So I think one is that you cannot wish away volatility, right? I think equities is a risk asset class. That means the price of it will be volatile. I've now been in the market for nearly 30 years. There are various cycles that have come about. There was Asian financial crisis, dot-com bubble, GFC, the COVID, etc. So the market does go through these phases, and you have to actually kind of try to stay objective through these time periods. You have to focus on really objectively looking at the data. Of course, even for example, today, you have to take into account that all factors are not in your control, right? So, for example, what happens on tariffs, we don't know. What happens on geopolitical events, you cannot control. But you should be in a position to really have a portfolio where you are balancing the risk element as well. And if, for example, the anticipation is that interest rates are going to come down, then growth stocks are likely to do better. I think the other important consideration is that you have to be very confident of the companies you own, and therefore you are able to really segregate the impact on stock versus impact on the company, right?
Sure.
And if you are seeing impact of macro events on the stock, but the company's performance is actually not impacted, then and if you are confident about that, you will be actually better able to withstand that volatility.
Ashish, golden rule, one nahi, I'll have to ask you many because I'm sure there'll be a list of them that one investor can use to build wealth. If you could list out a few of them, what should be the check mark or the list, at least in terms of rules, that one must follow?
I think first of all, you have to focus on the long term, right? And I know I'm repeating this that equity is a risk asset, and with this, what you mean is that the price is going to be volatile, right? And the best way to reduce this risk is increase the time horizon of your investment. And it's been, again, a proven fact that the longer the time horizon of investment, the volatility in the return comes down and the expected return also goes up. So the best way to enhance return is really increase the time horizon of investment. The second thing, particularly for the investors on your channel, I would say that you should start with clear goals, what you are investing for, and understand your risk tolerance, right? So that will help you identify the stocks or the funds that you are willing to take in. And I think if you just follow these basic tenets, I think investors should be well placed.
Okay. So follow this and at least you'll be well placed to manage and build some more wealth. But Ashish, what is the factor in terms of diversification? We know over diversification happens. There are overlaps of mutual fund that happen. One key or importance of just maintaining the right balance of diversification. How should an investor be doing that in the current macro environment? And what is the mix or something that you would tell us in terms of different asset classes as well?
Sure. I think one important rule to really prevent from over diversification is you should diversify only to the extent that you can understand whether it's stocks or funds really well, right? So if you can understand 15 stocks very well, if you can understand 15 funds very well, you should diversify only to that extent, right? Because it is really important that you know what you own, and the better you know what you own, you will be able to really anticipate how these assets or how these investments will fare in a particular environment, whether they are doing well, they are doing according to what you expected, or they are not performing up to expectations. So your diversification should actually really be dependent on what is the span of attention you can place on the individual investment.
Absolutely.
And sorry, what was your second question?
No, just mainly in terms of how one should be actually looking to diversify between other asset classes as well. While you did mention specific stocks, so asset classes also, how should they go about that as well?
Yes. Yeah, so I think that is equally important. Yes, I think for the longer term, equity is the asset class with the longest tenure. So equity is potentially the best asset class over the longer term. But everyone investment goals have multiple time periods, right? And therefore, your asset mix should be broad-based across equity, debt, real estate, and of course now precious metals like gold. Uh, there are now funds available that do it for you. So there are multiple products that are available that toggle between equity and debt, or equity and debt and commodities dynamically as well. There are funds that also kind of give you exposure to international equities. But I think if you are actually a relatively new investor, uh, if you just diversify across domestic asset classes between equity, debt, and commodities, I think that should be adequate.
Absolutely, Ashish. But on that note, viewers, we're going to sip into a very short break and continue this conversation with Ashish after the break, so don't go anywhere. Welcome back to MF Corner on CNBC TV 18. Now, let's keep it going with the discussion in terms of what our CIO for the day, that is Ashish Gupta, is doing in terms of strategies and how they actually build their portfolio. Now, Ashish, is there some strategy that you all follow to be ahead of the curve in terms of volatility or global events? How do you judge? Because we know Trump tariffs are going on for a while. So do you make changes there? How do you all adjust your portfolio?
Sure. As I mentioned, we cannot remain unaffected by global events, right? Now, there are some events like geopolitical risks, which are the one-off event, and which may mean that there might be intermittent volatility, but really many of these do not change the course of the portfolio. So some such events we will not be kind of very reactive to, right? But there could be other events, for example, you mentioned tariffs, right? So those are something that we believe demand attention. That may require changes to the portfolio a bit more actively. It could be potentially impacting some of the sectors and companies fundamentally. It could affect demand for some export-oriented companies. So, for example, over this period, as this issue has become more of front and central, we have actually reduced our way to export-oriented sectors like IT services and export-oriented companies. So you have to actually look at each event on its own and first decide whether it is just a one-off event or is it going to have really a fundamental impact. If it is one-off event and it will hopefully not play out for a long time, then the portfolio might not need too much of a change. But some of these things are going to impact the companies fundamentally, and therefore we have to reposition the portfolio.
Absolutely. You have to, but risk with risk, there is return, right? Higher risk, higher return is what we talk about. Though we want no risk and only returns, risk is something that scares everyone. You said volatility is a part and parcel of the market. You mentioned it time and again through the interview. Can you share a way that you have managed some risk that you all have faced in some point of time and has really saved the day, or that could help our investors as well?
So I think, as I mentioned, one thing is being really confident of what you own and building a portfolio where the risk, if you define it in terms of volatility, is reduced. The other risk is always that one should not get caught up in the mood of the market and fall prey to many narratives necessarily that are running through, right? And I think one instance I can share is of our small cap fund that, like all our funds here, also we manage, among other this, the portfolio liquidity risk. And in fact, despite running a fund that is majority into small caps, the liquid.
I think we've snapped the line with Ashish. We'll connect back with him as well. He was giving us an example. Yes, Ashish, continue.
Yeah, sorry. Yeah, so I was mentioning our small cap fund has one of the best liquidities as well as low standard deviation, the way the portfolio has been constructed. And therefore, even though last year or in the last 6-9 months, we have seen huge volatility in the small cap index, and we saw a drawdown of over 20% in the index level, our fund did very well and actually now is the best performing fund in its category for the last 6 months. So I think if you are able to really stay away some of the narrative driven investment, you manage the liquidity as well as the sizing of individual investments well, you can manage the volatility much better.
Ashish, what has been your biggest lesson so far as a CIO, that you've learned in terms of investing?
So I think uh, uh, my biggest lesson remains that one has to be objective and not fall prey to market narratives. And actually, over the last 10-15 years, we are seeing this becoming more and more important because of the social media and overall media overload. What is happening today is that news and information is being transmitted simultaneously to everyone, right? And what that drives is that everyone is actually tending to react similarly because everyone is getting the same information literally at the same time. And that leads to much more reactive nature of the market. It leads to a lot more herd mentality taking over rational thinking in the market. So I think it becomes even more important to kind of stay objective during this, not necessarily react to every piece of information or news that may be coming your way.
Absolutely. And, Ashish, if you are investing your own money today, what would be your mix? What would be your consideration when you're picking up a fund? And how would your asset allocation actually shape up today?
So I think in today's environment, I would add exposure to hybrid funds. I think they are a great way to actually get opportunities both in the equity as well as the fixed income market in India. I think given the macro we have and the strong returns equities have given over the last 4 years, I think over the next 12 months, returns in equities will be more modest compared to what we have seen in the last 3-4 years. So I would prefer hybrid fund at this stage. Over the course of last year, I've of course also added some passive and thematic funds because I think those are certain products that give another flavor to investing.
Okay, Ashish, thank you so much for joining in with us, giving us insights in terms of market, the conditions, and what you should be doing while there is risk. Learning from a CIO is very important for us as well. So thank you so much for joining us on the show. And
thank you for inviting me.
Thank you. And viewers, with that, we're absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, if closing bell to take you through the last hour of trade.